So, hello again and welcome to my channel where I translate technical accounting lessons to a storytelling version, sort of. So, in the past episode, we have already analyzed Baby G's notes receivable from Papa G and Daddy G. So, this is their full analysis. And using this analysis, we plotted it here to answer the three questions in this comprehensive problem. Okay? So in this video, let's continue analyzing and let's start with Sergey's promissory note. So as we have here, we have Sergey's note that has a value of 600,000 on November 1 with an interest rate of 24%, which is due in 13 months. And as you observed, there are no other twists like discounting, like dishonor of notes receivable and the like. So it is simple. What we will do is just to plot this 600,000 on November 1, and then we just need to get the interest for 2 months. So that's from November 1 to December 31. And we have 600,000 times 0.24. That's from here. And then multiply it with 2 months over 12 months. And we will get an interest of 24,000. So the total receivable of Baby G is 624,000. 600,000 is for the note receivable and 24,000 for the interest receivable. And that's it. Okay? Now, let's plot. So, for Sergi, there will be a trade current note receivable because although the maturity date is 13 months at November 1, 2 months has already passed if we talked about December 31, 20x3. Therefore, there are only 11 months left until due date if again we're talking about December 31, 20x3. Okay? Meaning, this 600,000 notes receivable from Sergi is a current asset. That's it. Okay? So continuing, there is no loss on discounting. And as to interest collectible, we have 24,000 and that's from here. Okay? Now, let's go to Professor G's note. So, unlike the other notes that we have discussed, this one here is non-interest bearing. Now, our default when we talk about non-interest bearing notes and when we get the initial value should have been to get the present value through discounting this amount. However, there is an exception if you can still remember, which is if the maturity term is 1 year or less, then there is no need to discount anymore. And I hope you still remember. So, let's just plot this 500,000 in November 30 or December 1. So, that's just the same if we're talking about timelines and amortization tables. Okay? Now, let's go back. We cannot go forward to another date because on November 30 also, Baby J decided to sell the notes receivable. So, again, we need to fill this entry up. So if there is a discounting, remember always that there is this entry. Okay? Now, no need to compute for interest that Baby G deserves because on November 30, Baby G received the promissory note and on the same day, such note was sold immediately. Okay? So credit immediately notes receivable for 500,000. Now, the problem is the proceeds or this debit cash. So again, that's maturity value, which is this 500,000 immediately also. Because again, if we're talking about non-interest bearing notes, the interest was already embedded in the amount of the note, which means that this 500,000 already includes principal plus interest. So again, that's already the maturity value because this 500,000 already includes the interest. So for the discount, that's maturity value of again 500,000 times the discount rate of 0.18 or 18%, and that is based in here. And then times the unexpired time, which is 1 year or 12 months over 12 months, and we have a discount of 90,000. So the proceeds is 500,000 minus 90,000. So let's debit that as cash here. Okay? And then, the balancing figure is the loss on discounting of 90,000. And that's it. That's the full analysis of Professor G's note. Now, let's plot. Of course, for Professor G's note, the note receivable trade under current assets at December 31, 20X3 is already zero because it has already been sold last November 30. And the loss on discounting is of course 90,000, and that is based on the computation here, and there is no interest receivable already. Because one, this is a non-interest bearing note, so it's impossible to have an interest receivable. And number two, again, in November 30, the notes receivable was already sold. So it is impossible also to have an interest receivable related to this notes receivable on December 31, 20X3. Okay, now let's have Bumble G's note. So, like Sir G's note, there are no complications for this one. So, this is just a note on December 1 with a value of 900,000. So, let's just immediately plot that here. Okay? And then, this note has an interest rate of 18% based on the problem and is due in 5 months. Okay? So, what we need to do is just to get the interest rate for 1 month. So, 900,000 times 0.18 or 18% times 1 month over 12 months. And then we have the interest of 13,500. So, that's it for Bumble G. So let's plot on the requirements. So on Bumble G, we have 900,000 as the current notes receivable trade because on December 31, there are only 4 months until maturity. And then 0 on the loss on discounting because there is no discounting on this note. And on interest receivable, we have 13,500 based on this. Okay? Now, it's time to go to the last one. So we have Dean G's note. Now, immediately, I will tell you that this receivable is presumed not related to trade because, as the problem says, Dingy is the president of BBG Company. So it is presumed that Dingy borrowed something for personal reasons and not related to the normal course of business of BBG Company. So that's the main twist here. Okay? But aside from that, the same with Bumble G and Sir G's note, there are no other complications. We just have to plot its amount, 1.2 million here in December 1, and then get the interest. So 1.2 million, 1.2 million times 0.12, which is based in here, times 1 month over 12 months, and we will get 12,000. And that's it. So let's plot this analysis in here. So on Dean G's note, the current trade note receivable is 0 because again, the notes receivable is presumed to be not related to the normal course of business of BBG. The loss on discounting is also 0, but the interest receivable is 12,000, which is based on this computation and analysis. And that's it. Well, to end this episode, we still need to summarize the answers. So the current notes receivable trade, if we total this, we have 1.5 million. And then the loss on discounting is 90,833. And if we add this all up, we have an interest receivable of 67,500. Which means that the answer for these three questions right here are letter A, C, and D. And that's it for the comprehensive problem solving. So in the next episode, let's have the last twists on notes receivable discounting before we go to accounting for bonds. So that's the end for this video. So if you learned, please click like, subscribe, and hit the notification bell to be updated on my next videos. And again, thank you for watching and see you on my next one.